If you follow the investing journeys of Monish Pabrai, Li Lu, and Guy Spear, then a company you're probably familiar with is Micron. The stock is currently owned by a who's who list of super investors, including the three lads I just mentioned, along with legendary investors like Seth Klarman and Bill Ruane. So in this video, I'll be analysing Micron and trying to value the business to see if there's an opportunity over a shorter time frame. I say shorter time frame because in my last Micron video, I explained how I thought Micron wasn't a long-term compounder, but as a cheap sort of 50-cent dollar investment with a shorter holding period, there's potentially an opportunity for a quick double or maybe even a triple. So I'll be taking off my compounder hat and looking at Micron through the perspective of a Graham-style investor. And if you haven't seen my previous video, I'll put a link in the description box below. Alright, first up, I'll go through some of the reasons I like Micron as a potential investment. And the first one, which I touched on briefly in the previous video, is the economics of the memory business. Micron essentially operates in an oligopoly with two main competitors, Samsung and SK Hynix. But this wasn't always the case in the memory business. Monish Pabrai explains that a few years ago, the memory business was a terrible business to be in because there was a dozen companies in the industry all engaging in a price war, which of course ended up with no one making any money and a lot of companies going under. Whereas now, because the memory business has been consolidated into three main players, he thinks it's not as terrible a business as it used to be. And this reminds me of a point Buffett says about using the past to predict the future.
If we find something where the competitive aspects are, it's just the nature of the business that you really can't see out 5 or 10 or 20 years, because that's what investing is seeing out. You don't get paid for what's already happened. You only get paid for what's going to happen in the future. The past is only useful to you in the extent to which it gives you insights into the future. And sometimes the past doesn't give you any insights into the future.
Most of the time, using a company's past to give you insight into its future is beneficial. But as Buffett says, sometimes that's not the case and it doesn't give you any. And I think this is potentially the case for Micron. If I take a very broad outlook and look at technology or computing as a whole, or even just memory as a whole over the last 15 or 20 years, do I think the next 10 years will look similar to the past with all its boom and bust cycles? And I think the answer is no. I personally think we're entering an era where the use cases for memory are increasing significantly, as well as the amount of memory deployed per unit, as the complexity of things like computing and AI increases. I think it's widely accepted that in the next decade, we'll probably see autonomous vehicles, VR gaming systems, AI-powered robots, and much more, which will require huge amounts of memory. And then there's also the things we have already that are becoming more complex and using additional memory, like smartphones for example. A 5G phone needs 25% more memory and double the storage of a 4G phone. And then there's also the advancements in data centers, tablets, laptops, and so on. Now, whether Micron will be the main benefactor, I'm not sure. But overall, I don't think looking at Micron's past is the best way to get insights into their future. And I think the next decade will look very different to the last decade. In saying that, I'm not sure it's a business I can forecast or predict with any certainty. And even though I can imagine destinations that are positive for Micron, because this is more of a short-term play and not a long-term buy and hold, it means I have to be pretty accurate about projecting the next few years for Micron to be able to value the business in something like a DCF. Now, there is an argument to be made that even though Micron's free cash flow is pretty unpredictable, it doesn't matter as much because at the current price, Micron is trading for a small premium to its liquidation value, and you're essentially getting the stream of cash flow for free when you buy the business. I think this is the easiest way to value Micron, instead of trying to forecast their future cash flows. And I have a theory that this is Li Lu and Monish Pabrai's thesis for Micron, and how they valued the company. Before Monish was influenced by Nick Sleep in 2021 to focus more on what he calls growing pies, his approach to buying businesses was looking for discounted pies, or businesses selling for much less than they're worth. And in his interviews, when he mentions past investments, he talks a lot about buying businesses for less than the true value of the assets. So let's have a look at Micron and I'll see if I can value the underlying business. If I go to QuickFS and look at the financials for Micron, you can see their free cash flow has been pretty lumpy over the last 10 years. But if you look at Micron's book value, it's been much smoother and has been steadily growing over the last decade and compounded by around 20% a year since 2013. In Buffett's letters, he says they sometimes use book value as a proxy for intrinsic value, and he says that in Berkshire's case, their intrinsic value is much greater than their book value. In Berkshire's letter from 1983, Buffett explains that they report their progress in terms of book value because in their case, it's a conservative but reasonably adequate proxy for growth in intrinsic business value, the measurement that really counts. Book value's virtue as a scorekeeping measure is that it's easy to calculate and doesn't involve the subjective but important judgments employed in calculating intrinsic value. It's important to understand, however, that the two terms are very different. Book value tells you what's been put in, and intrinsic value estimates what can be taken out. He explains below using a simple analogy. He says, assume you spend identical amounts, putting each of two children through college. The book value for each child, measured by financial input, would be the same, but the present value of their future earnings, their intrinsic value, might vary enormously, from zero to many times the cost of the education. At Berkshire, at the beginning of 1965, when present management took over, the $19 per share book value considerably overstated intrinsic business value, as all of that book value consisted of textile assets that could not earn on average anything close to an appropriate rate of return. Whereas now, because Berkshire's assets generate above average returns on capital, their intrinsic value is far greater than its book value. So one of my biggest takeaways from that whole section is that it kind of comes back to return on capital when you're analysing the book value. I know at this point I probably sound like I have man with the hammer syndrome, because even when I say I'm taking my compounder hat off, I still end up yapping about the return on capital. But hear me out. If a company's book value consists of assets that generate above average returns on capital, then the intrinsic value is probably much greater than the book value. And if it consists of assets that generate low returns on capital, then the book value is probably overstating the intrinsic value. I say probably because what I just said is kind of a heuristic and it's not always reliable. So if I apply that logic to Micron and look at their return on capital and their return on incremental capital over the last decade, although it's not amazing, it's still an above average business. Micron's return on capital employed today is about 16%, whereas the average business in the US is around 10 to 12%. And their return on incremental capital is about 15% over the last 8 years, which is pretty good considering they had pretty lumpy earnings throughout the decade. And if we look at their return on capital over time in quick FS, because their earnings are a bit all over the place, the return on capital is pretty up and down. But on average, I reckon it's probably around the mid-teens, which would be slightly above average. So overall, I think Micron's intrinsic value is worth a lot more than its book value, considering they generate above average returns on their assets. It's hard to know what their intrinsic value is exactly, because their cash flows are so hard to predict. But based on the fact that Micron's book value is $50 billion, and Micron's enterprise value is $57 billion, I think Micron is pretty undervalued. And that's tangible book value too, which doesn't include all of Micron's intangible assets that are definitely not worthless, like all of their patents and IP. So I think overall, Micron is selling for roughly its book value when you factor in these intangibles, and you're essentially getting the cash flows for free. Now to finish off the valuation, I'll do a quick discounted cash flow for Micron. I know I said before that there's not much point in doing a DCF for Micron, because their cash flows are all over the place. But I decided to do one anyway, and try to estimate the future cash flows I can take out of the business. So I took their current free cash flow of $3.1 billion, and I used pretty conservative growth rates for the next 10 years. For years 1 to 5, I used a 12% growth rate, and for years 6 to 10, I used 10%. Next, I used a discount rate of 10% and a terminal multiple of 12. As Micron's not a high quality business, but is still above average. So that gives me a rough estimate for Micron's intrinsic value of $74 billion for the entire business, or around $68 a share, which makes Micron undervalued, but not by much according to my estimates. Although I'm probably way off to be fair, because I'm not sure what the future cash flows will look like. So overall, while I think Micron is promising, and I can see why investors like Monish and Lilu are buying into it, because I can't determine the value of the business today with any sort of accuracy, I'm probably going to take a pass on Micron. To be honest, even if I thought Micron's intrinsic value was double the stock price and it was selling for 50 cents on the dollar, I'd probably still take a pass on Micron for the same reason I gave in the last video. When it comes to buying businesses, if I have to choose between a quality long-term compounder and a good business that's cheap, I'll take the compounder every day of the week. And right now, I'm currently looking at a few quality compounders that are trading at good prices, courtesy of the market. So that's where all my focus is at the moment. So that's my analysis for Micron, and I hope you found it useful. And if you enjoyed the video, please consider hitting the like button. As always, if you have any questions, or if something I said didn't make sense, then let me know down in the comments below, and I'll do my best to answer. And if you watched the video all the way to the end, thank you so much for all of your support. So that's it for this video. Thank you so much for watching, and I hope to see you guys back in the next one. Hey guys, do you track your portfolio manually in an Excel spreadsheet? If so, you can avoid so much hassle by signing up to ShareSite for free. ShareSite is the portfolio tracking tool that I use to track all my investments. And unlike most brokerages, ShareSite automatically tracks everything including capital gains, dividends, and also currency gains if you invest in foreign markets. It's also completely free to sign up to ShareSite, and you can use it for as long as you like. And if you sign up to a paid plan, then use my referral below. sharesite.com/investingiq, and you'll get 4 months for free when you sign up to an annual plan. So what are you waiting for? Go check out ShareSite.